But today I want to share something that a lot of agents have questions on, and it's something that we're constantly going through as well, is talking about the types of money that we can use for annuities, okay? And how to transfer, how to roll over, non-qualified, 1035, all of these different things, because it's very confusing, especially in the beginning. And there's always these weird circumstances, like they have a simple IRA or they have a SEP IRA that they don't want to contribute to, or that they still do indeed want to contribute to. How do you move that over into an annuity? One of the easy ways to think about this is that I always explain to clients, think of a bucket from Home Depot, okay? That bucket is the tax code, whether it be an IRA, a Roth, a SEP, doesn't matter, okay? It's a bucket, which is the tax code. You can put whatever you want inside the bucket: stocks, bonds, ETFs, mutual funds, an annuity, okay? So a lot of times people will think that annuity is, they'll just assume that it's, its own separate tax code, which it really isn't if you're talking about qualified money. Non-qualified, there's a difference. We'll get into that, okay? And then real quick too, just to notate, on the calls here, we're growing so fast and we're so busy, and we're actually going to be moving to a new office. I'm going to try to trim down the calls a little bit just in the spirit of time to a solid 30 minutes. And as you know, it's not all motivational hype on these calls. It's as much information as I could possibly expel during this time. And if you have questions, raise your hand. You want to bring cases to the table, you totally can. You can even, I can open it up where you can talk. It's totally communicative, okay? But the main basics of rollovers and transfers, let's get into that. The easiest to do is a cash with app, okay? But that's a non-qualified. If we're talking about doing qualified money, the easiest is a 401k rollover, because you literally just call the annuity, or sorry, the 401k provider, and you request them to roll it over. The reason why it's called a rollover is because you're changing the tax code. Think of that. You're rolling it over. You're changing it. Okay. You're changing that tax code to an IRA. So you cannot have an annuity 401k. Okay. What you can do though is take the 401k and do a rollover into an IRA, and there's no tax penalties. Now, when you roll it over, you can do a partial rollover, or you can roll over the full amount of the 401k. There are some rules though, because if your client's 55 years old and they're not quite 59 and a half, okay, they may not be able to do a partial in-service rollover. That's what you would want to ask for into their own IRA. A lot of plan administrators don't allow that. You have to be at least 59 and a half years old, okay? Some of them do. I mean, I think I've done one that allowed it, but most of them won't. So if you got a client who's 55, 56, 57, and so forth, you're not going to be able to roll over that 401k most likely. You just got to sit there and kind of wait it out, all right? Now, some 401k providers will allow for a partial rollover. Some won't. Some, they make you roll over the entire thing. All right. Now, if that's the case and it's not suitable for the client to move the entire balance, then what you have to do is have them roll it over into an IRA through Fidelity, Schwab, doesn't matter, have them create a quick little IRA account, roll the money over into that. And then from that point, you transfer the money to another IRA. See, transfer is like to like. SEP to SEP, Roth to Roth, IRA to IRA, transfer. You're just moving it. You're not rolling it over and changing it. A SEP IRA to a IRA is a rollover. You're changing that tax code status, okay? And then it gets a little bit confusing, because if you have an IRA, you're converting to a Roth. If you exchange it into a Roth, you're converting it because it's already an IRA. You're just converting it. So there's conversions, transfers, rollovers, okay? And then we'll talk about 1035s and non-qualified exchanges. But you want to make sure that they can actually move those funds over. And one of the easy ways as a sales pitch to them, if you want to call it a sales pitch, is, your company is not offering you a 401k. What if you could take a portion of your, a pension? What if you could take a portion of your 401k and turn it into a pension that pays you for the rest of your entire life? Would that be of interest to you? Oh, that's great. Because most people, if you ask them if they've been at a company for, say, 20 years, if you could go back in time 20 years and your employer today offered you a guaranteed lifetime stream of income through a pension or a 401k, and you had to choose one of the either, which one would you probably choose? And most people will say a pension. You want to fill out the conversation, obviously, but most people will say a pension. I go, great. Well, this is your opportunity to create your own pension with some of your 401k. And it really starts clicking with them. Okay. And then you always want to call the 401k administrator. You can do it online on a lot of companies, but I mean, I don't like to do that online. And most clients, they might mess it up. So you always want to call the 401k provider and to find out a few things. Number one, what percentage of the 401k is fully vested? Some 401ks have unvested shares inside of them. You can't move the unvested. You can only move the vested. Okay. You also want to ask if there's pre-tax and post-tax monies inside the 401k. You'll be surprised. A lot of times 401k providers will simply have the actual 401k, which is pre-tax, and then they'll have a bucket like a Roth 401k that is post-tax. Well, you can't combine the two into an IRA. You'd have to have a Roth and then an IRA. You got to match the tax code so there's no tax penalties. And then sometimes where it gets really fun is if they're only going to send one check and they won't separate the two and leave some in the account. Some of them will make you, they'll just send one check and totally liquidate it. Then you have to write another application for the Roth portion that gets mailed out. Okay. But you find all this out by simply calling the 401k provider. So take the application, get it approved, then call the 401k provider. You do not have to worry about transfer paperwork when it's an actual 401k. Okay. You just simply call them. The 401k provider will mail the check either to the company that is going to be receiving it that you wrote, or they're going to mail it directly to the consumer. Now, people get weird about that. Like, well, I don't want the money in my name. I'll get taxed. The check is made out to the receiving company for the benefit of the client. So that way there's no tax implications. And even by happen chance, if they messed up, you have 60 days to take money out and put it back into another 401k or another IRA or qualified account. You have a 60-day rule. Now you can only exercise that rule once a year. So don't be doing that with multiple accounts for the clients. There's only one time per year. Okay. But worst case scenario, you could do that. So the 401ks are great. You just call with the client once everything's prepped up. You tell them that they would, the client says, okay, I'd like to move over 100,000 or whatever it may be into my new plan. They'll go ahead and sell the shares off. They'll provide you with a confirmation number. You get a tracking number. You confirm if they're going to mail it to the client, if they're going to mail it to the company. Always ask if they have expedited shipping, because if not, they're going to do it regular mail. There's zero tracking on it. It's worth it. Okay. It's usually 20 or 25 bucks. You're still below the rebating limit in most all states. So it's not a big deal. We always prep the client that we're going to ask for expedited shipping and we're going to give you an Amazon gift card for 25 bucks. We'll pay for it for you. Right. But it's totally worth it. And they go, sure, no problem at all. That sounds great to me. So always ask for the expedited shipping. The other thing that they're going to require on this 401k is a tax notice notification. They're going to ask the client, have you reviewed the tax notice? And if the client says, no, I haven't, what's that? Well, now you got to wait and they got to send it to the client and it takes forever. Okay. Sometimes it's fast and they get an email and they can just say, okay, I received it. And then they'll go ahead and proceed with the rollover. Now, what you should do is prep the client beforehand. You tell them, look, they're going to ask if you reviewed the tax notice. So before we get onto this call, let's log in your 401k provider, click on the tax notice. And that way you can say that you have seen it, right? Or if it's a very analytical client, you can say, go ahead and call them, ask for the tax notice or log in online to take a review of it. All it's stating are what are your options and tax penalties with moving money outside of a 401k. But again, there is no tax ramifications if you're simply rolling it over to an IRA, but they want you to acknowledge that you have seen that and you understand what's going on. Fair enough? They go, fair enough. So this way, when you're on the call and they say, have you received the tax notice? The client can say, yep, I have, I'm good to go. Great. That's all they want to know. They just notate it on their call notes, okay? It generally takes 3 to 5 business days, even when it's expedited. If it's not expedited, it can take 2, 3 weeks, and the Postal Service can lose it. We've had millions of dollars lost by the United States Postal Service, probably because it's a government entity and it's ran terribly. So we always opt to pay for the FedEx or UPS. Now, this is where you should have a FedEx account set up for yourself and a UPS account set up, because sometimes the 401k provider will not provide the FedEx or UPS label. They say, we'll use your account. And okay, fine, here's my account. Some of them will say, nope, we can't use your account as the agent. We have to have the client's account set up. Well, then in that case, you might have to call back and you set up a UPS or FedEx account with the client. And then we provide those details to the carrier or to the 401k provider, and then they send the checks out. And this is just high level. There's obviously a lot more weird stuff that can happen, but generally, it's one of the easiest processes is the 401k. Super easy. Now, remember, it's a 401k, so it's regulated by ERISA. You should be having your PT-84 forms filled out. We've already done multiple trainings on all the disclosures that we use, but you need to keep that for yourself. Do a lot of carriers provide it? No. Is it technically a requirement? Yes and no. It's better to have it and not need it than to need it, not have it, okay? All it states is it's a little disclosure that the Department of Labor has created, because you always want to have all your ducks in a row. This is why we talk about getting the disclosures. You can use our disclosures. Are they approved by compliance? No. Are they approved by an attorney? No. They're just our own general information about the annuities and the process. You're free to use them. But again, if you have a broker dealer or you want to have them reviewed by somebody, you totally can, or you don't have to use them. It's your business. But we use them all the time because it helps the client better understand the process, and it helps protect us as well. We've done trainings on that multiple times. So that's the 401k rollover to an IRA. All right. Now on the applications, you might not see 401k to IRA options. Well, when you're marking the boxes, just mark rollover, because it says, is this going to be a transfer, rollover, cash with app? Just mark rollover. Some annuity providers don't even have the word rollover on there. Why? Because that would be simple, and they're not going to do that. So you can still mark transfer, and then in the agent notes, right, this is a 401k to IRA rollover. That way you at least notate it somewhere that you put that into there. Okay, so that's 401k. Now, the next one is transfer. Let's say that that 401k has already been converted to an IRA and it's just sitting at a brokerage company, right? It'll say 401k rollover IRA on there. So it's not a 401k. It is now an IRA. You need to do a transfer, which requires transfer paperwork. Okay. So in this case, what you're going to do once a client is all approved and you have a policy number for them that these 401k providers and transfer companies can reference in the memo. Some of them do, some of them don't, but it's good to have that. Then you call with the client, the the company that's holding the money, and ask them a few questions. You say, look, what's the current balance? Are there any charges on this account? Are there any fees to move it? You get all these details. In order to move this money, does the client need to put the money into a cash position, or will you, as the custodian, automatically put it to cash once you receive the transfer paperwork? Some do, some don't. Okay. Most of them don't. The client needs to say, put it to cash, and then it sits to cash. It does not create a taxable event because it's still inside of that umbrella or that bucket of the IRA. So they need to put it to cash, because when you purchase an annuity on the safe money side of things, not a variable, you're not buying an investment. It's an insurance policy. You're not owning shares or anything. It's a contract with an insurance company. So that money will transfer over cash to the annuity, and it sits in cash inside the annuity. Okay. So you need to clarify and ask, hey, look, do you require us to transfer or to convert this to cash, or will you automatically do it once the transfer paperwork comes in? Right. Just get those details. Then you need to ask them, do you require any additional forms on your end in order to move the money, or will you accept the third-party transfer forms and LOA, which is letter of acceptance from the receiving carrier? If they say, yes, we just need their forms, we're good to go. Wonderful. You follow up again. You ask, do you require a medallion signature? Do you require notarization? Right? Sometimes they'll hem and haw. They don't know. They got to ask somebody. But if they do, it's better to find that out now. And if you need medallion support, we have that through our agency, but that's a whole other story. You want to find out what is actually required to move that money over. Because a lot of agents will call and say, like, damn, this thing's been sitting there for like a month. Well, you got to call and grease the wheel. These big institutions don't want to let go of the money. Okay. And it's very cumbersome to get them to do that. If they do accept the transfer paperwork, you also need to ask, do you accept faxed paperwork, or do you need original wet signatures? Some of them require original wet signatures. If they require that, what's the mailing address? Who do we put the attention to? If they accept fax, then you say, okay, great. What is the fax number? And who do we fax it to? Because on brokerage companies, you can have 4 different sub accounts on there, right? You have the main custodian, the broker's agency. There could be a sub broker's agency, and you have multiple account numbers. So you want to clarify all that while you're on the phone, so it's a clean, concise process. Then you always ask with the client, how long does it take once you receive the forms to process this order? They'll usually say 5 to 10 business days. Okay, fine. Notate that in the calendar. You also want to let your client know that, look, we're going to send this transfer paperwork into the company that's going to be receiving the funds. They are then going to send it to your current company to move the money over. That way, nobody touches the money. It's institution to institution. However, when the money leaves your account, okay, we don't know when that happens. So we have had people in the past call like, oh my God, my money's gone. Where is it? You don't have it. Yeah, it's probably because it's in the mail. All right. But you want to let your clients be aware of that. And then I always encourage them, look, if you happen to check your account periodically, let us know when you see the money leave. This way, we can follow up and notate in our system that we're expecting the funds. And they go, great, no problem at all. Then I let them know once the funds have hit, it's going to take probably 7 to 10 business days for this new company to get the funds, process them, and then issue the policy. Then they're going to mail it. And that takes 7 to 10 business days. So overall, it's going to take us about a month to get this policy active in force and into your hands, just to set a realistic time frame. Okay. The other thing that you want to double check on these transfers is spousal signature. Some require it, some don't. Here's a safe way to do it. Always have the spouse sign, especially if you're in Texas or any other community property state. Just have the spouse sign anyway. And they'll always sign in joint owner because they don't know any better. So have them sign in the spousal section. That way, you don't get any potential kickback. So that's a transfer. That same process is applicable from IRA to IRA or Roth to Roth, okay? Or SEP IRA to SEP IRA. Now, if you're dealing with a SEP IRA, okay, then what happens is you have to have a separate form filled out with the company's information, contribution stuff. It's not that big of a deal. Now, if you're moving it from a SEP account to another SEP account that you're selling with an annuity, you want to make sure if they plan on contributing that new annuity will accept flow premium. Most carriers, it's one and done. That's it. So if they're planning on contributing continually, you want to make sure you're planning accordingly and not have any surprises. A lot of people, they'll just move it over and they can just say, yeah, I'm just going to move it over as the SEP, or you can roll it over into an IRA. So you can change the tax code from SEP to IRA, whatever you want to do. It's simple just to do a transfer, or you can roll it over to an IRA. The advantage of the IRA is that maybe they're no longer working at that employer. They're no longer owning their own company. They're now working with an employer and they still want to contribute to this account. Well, you can't contribute to a SEP unless you're running your own business. So this gives them an opportunity to contribute to the Roth on a flow premium annuity if they choose to. So you want to get all the details. That way your recommendations are sound and you don't have to worry about them calling, hey, I mailed a check and then they mailed it back to me. Why aren't they taking the money? Okay. They can also always open up another SEP account with you on another annuity. You just have to make sure that what they're going to contribute into it meets the minimum of that new annuity. So for SEP, you can transfer SEP to SEP. Most all carriers will accept that or you can roll it over, SEP, roll over to IRA. Totally up to you. Okay. So keep that in mind. So that's qualified money. The reason why I didn't go deep into Roth, because it's the same thing. It's just a transfer. Okay. Now, if they want to convert money from an IRA to a Roth, you can do that a few ways. You can do what's called an in-flight conversion. So the money leaves as an IRA, and then before it hits the new company, boom, it converts, or when it hits the new company, it automatically converts over. If you're selling a Roth conversion strategy, you want to make sure that the company you're selling will allow for partial Roth conversions. Some only allow for full, and the full may be fine as long as that's what the client wants to do. Or what you have to do, if it's a really good product and they want to partially convert, but the company doesn't allow for a partial conversion, you just have to sell 5 applications. And most companies will make you fill out in its entirety 5 applications. So if there's a $500,000 rollover and they want to convert 100 grand a year in the next 5 years, you're going to have to write 5 applications. Some companies will just let you click a button and duplicate. And it's not a big deal. You just let the carrier know on the apps, we're going to be submitting 5 apps for the purposes of Roth conversion over the next 5 years. Not a big deal. Okay. So things to always keep in mind there. Now, the other part of the money is non-qualified money. Okay. Non-qualified money is cash in the bank, a brokerage account, okay, that is not inside of a qualified retirement account, or it could be another non-qualified annuity. So let's look at the first one, cash in the bank, non-qualified. Just write a check. Doesn't have to be a cashier's check. Just literally write a check, send it in. Now, the thing that you want to keep in mind too, a lot of husband and wife own a joint checking account. Some carriers will want both signatures, okay, or the acknowledgement of the other spouse. Some people say, well, it's all my wife's or husband's name. I'll just write the check. But the check says the husband's name and the wife's policy is in her name. They're going to have an issue with that unless you write a cover letter explaining it. Okay, so keep that in mind. That's just non-qualified. No big deal there. One thing to keep in mind about non-qualified annuities is that if they're under 59.5, there's a 10% penalty on all of the interest that's accrued if they access it. So it's treated like a retirement plan. And there's no step up in basis, okay, like qualified, like a brokerage account would have with stocks, okay? Now, if they're going to sell their brokerage account to put into the annuity, there is potential tax because they have to sell their shares. They'll pay either short-term or long-term capital gains tax on what they bought it for versus what it's sold for. Now, if there's a big loss in the portfolio, there's no tax. So you want to be cognizant of that before just moving money over from a brokerage account because they're going to get a tax bill by selling those shares to create cash, potentially. That's why you got to call and ask what the cost basis is and figure out all the details on how they move it over, okay? So that's non-qualified money that is considered, it's just non-qualified. It's not technically classified as a transfer per se. Now, the other bucket of funds here is that they have a non-qualified annuity that you are replacing for another non-qualified annuity. This is now technically an exchange, specifically a 1035 exchange. So the difference that you really need to be sure of is that if you don't know this, and if you mark on that transfer form, the application, it's a non-qualified transfer, it triggers the basis, which means that they will pay taxes on the growth of that non-qualified annuity versus what they paid into it. It's not a tax-free transfer if you're just doing a non-qualified transfer. You have to specify this is a non-qualified annuity. We are performing a 1035 exchange. That way, the entire the basis, and all the money that's grown to transfers over into the new company without any tax consequences. So you got to be very, very cognizant of that. You always want to call to ask if they will allow for a 1035 exchange. Believe it or not, there's old annuity contracts that do not allow for 1035 exchanges. There's some that don't allow for partial 1035 exchanges. This is why you need to call the carrier to get all of that information. So when it comes over as in the new contract, it'll simply say, hey, non-qualified annuity 1035 exchange. There's no tax consequences. And annuities are always taxed, last in, first out. So if they take a distribution of that annuity, say if there's 100 grand in there and it has 10,000 in growth and they want $5,000, $5,000 is going to be the tax bill as ordinary income. Okay. There's no short-term or there's no long-term capital gains inside of an annuity. All right. Because you're not owning shares. It's just cash. Danielle, at the end of a 10-year contract, as an example, does the insurance company have the ability to cancel the contract with the annuity? It depends. What they'll do at the end of a 10-year contract, most of them, if you read it, it'll say they have to annuitize by the age of 100 or take the money out. That's how most contracts read. So after a 10-year period, unless it's a MIGA, then it just is 100% liquid. They could take it out anytime. The insurance companies don't force people to take it out. Okay. Now, if it's a MIGA, then it could relock itself in to another period, another surrender period. You have to make sure the details there. And a lot of MIGAs, you have like 30 days to make a decision. This is why staying on top of annual reviews is so important. But at the end of that 10 years, then you can, again, 1035 it to something else. Now, if they want to say, hey, at the end of 10 years, I want to maybe buy stocks with it. Well, if they do that, they're going to pull it out of the annuity bucket, okay? Out of the annuity bucket. They're going to pay ordinary income tax on whatever the basis was on the original policy versus whatever it grew to. So it's like you can move it again if you want to stocks, but you're going to have to pay the tax and get it over with. And then you have a fresh new basis on the shares that you purchase, because it's not, the basis is not transferable if it's going outside of an annuity again. Okay. So always want to keep that in mind with the client. But those are the basic transfers. Let's see. So assume if there are long-term care functions attached, assume that will be good for life then. Well, long-term care, that's a whole other world, because you have a few things. You can 1035 a non-qualified annuity into long-term care policy for a certified long-term care policy that allows for that. It's called the Pension Protection Act that was put into place, I think, 2006. So you can literally transfer that non-qualified annuity into a long-term care policy, okay? And the basis is never taxed anyway, but the growth that it received is also 100% income tax-free, even though it's inside of an actual long-term care annuity policy for the purposes of long-term care. It's a great selling point. We did one of the biggest rollovers for asset-based LTC with 2 years ago. A guy had a massive protective fixed non-qualified annuity, didn't even need it. But he needed long-term care. I'm like, well, why don't we just take this old annuity that's not doing well and we'll move it into this policy and you won't pay any taxes because it's part of the Pension Protection Act and it's a qualified receiver of that through. We'll just transfer it over and you'll never pay tax on anything ever. And he goes, that's awesome. Let's do it. This is a really cool thing to keep in mind. Like, even when they take the distributions out for the purposes of LTC, it's not taxed. Perfect little code there. Now you can move money from annuities, or sorry, life insurance to annuities, but you can't move money from annuities to life insurance. They don't let you do, I don't know why, but you can collapse old whole life policies and then 1035 them into an annuities. We've done that as well, as long as death benefit's not needed, or if you sell them another policy with death benefit and they need income from that, you can do so. Again, you give up that tax-free ability with cash value life insurance because they don't provide loan options. And so they could do that, but then they lose that tax-free distribution. But if you run an in-force illustration on that whole life or UL, and you say, hey, look, if they want to take out this distribution, you match it with an income annuity, you'll see that their distributions won't last as long, right? It'll actually collapse it. And if the policy collapses on life insurance, then everything is taxable because it's no longer life insurance. And there's extra taxes associated with the loan interest rate. And so it could be a very bad situation if it doesn't have an overloan protection on it. So lots of details, but yeah, you can move it over into a long-term care policy you want and never pay taxes on anything as long as it's a qualified LTC policy that accepts that. But those are the basics of the transfers. We're actually creating internally here on our team transfer cheat sheets. So, and we'll share them with you. If you want to do a transfer, it's literally just fill out all these questions and then you won't screw up.